GST. Some fundamentals for you. GST on sales is a liability. GST on purchases is an asset. Normally reduces your GST liability. In other words, most of the time you will have a GST liability because a business will make more sales than purchases. If this doesn't occur, then I have no idea why you would be in business. The few reasons you may have a GST asset could be because of the following. So there was a large purchase of inventory, purchase of expensive non-current assets, or a lot of non-current assets, or because you just started the business, so you haven't initiated any sales yet, and you just made a whole heap of purchases. So examples of GST payable. So during March, the painting service received 410 from painting fees that it charged its customers and paid GST of 250 to its suppliers. So what we do is we figure out our GST opening balance. In this case, we have none. How much was our GST liability from the fees we received? It's 410. Take away the GST that we paid ourselves, 250. The difference between two, our GST liability, or how much GST we have to pay, will be $160. Alright, GST payable, receivable, and settlement. What's the difference between them all? Let's go through it. So GST payable is the GST owed by the business to the ATO. So this happens when the GST from your sales is greater than the GST that you paid, creating our GST liability. So GST receivable is when the business is owed money by the government or the ATO. This is where our GST paid is greater than the GST we received from our sales. And GST settlement is a payment made to the ATO by a small business owner to settle the GST payment. It's an operating outflow. So this happens, let's just say we owe the ATO $1,000 for GST. GST settlement is when we actually pay the cash to the ATO. So example of GST settlement. So on the 1st of April, that $160 we looked at earlier, we finally gave it to the ATO with our check 11. So there it is, date, detail, document, $160, and it goes in the sundries section because we do not have a dedicated column for GST. GST settlement. We do have one for GST, but settlement is a completely different animal, so put it in here, alright? So examples of a GST refund. On the 1st of July 2025, got painting service received a GST refund from the ATO for $320. We got receipt number 19. So here it is, date, detail, receipt number, how much did we get, and it's in the sundries column, not GST. So why is it in the sundries column? Well, because it's not GST that we received from a sale, it's GST that we got back from the government. So that's why it's a completely different thing, and we include it in sundries. So cash flow cover. This is a financial indicator that assesses the business's liquidity. In other words, its ability to meet short-term debts as they fall due. So this is an equation. Net cash flow from operating activities divided by the average current liabilities. So in your cash flow statement, the operating activities, the net cash flow there, put in the number, then divide it by your actual average current liabilities from your balance sheet. So here's an example. Current liabilities on the 1st of March was $2,000, and at 31st of March it was $1,600. So we need to figure out the average of the two. So all you do is add 2,000 and 1,600 together, divide it by 2, and voila, you got the average. So if we look back, we found out that our net cash from operating activities is $1,910. You divide that by our average current liabilities, which is $1,800, and it gives us a number that says 1.06. What does 1.06 mean? Well, it tells us that we can, for our current liabilities, we got 1.06 times the amount of money available to cover it. So effectively, we have enough money through our cash flow of operating activities to cover our debts as they fall due. Normally, you want it to be greater than 1, but when it comes to this close, like 1.06 times, it's living a bit close to the edge. So if we do have like a rainy day or some random occasion which causes some trouble in the business, it might be the difference between surviving and going bankrupt. So I suggest anything greater than 1.2, 1.3, but there's no rule saying that 1.06 is a bad thing, just as long as greater than 1. But in all honesty, my own opinion, have it a bit higher to give yourself a little bit of leeway and survivability. So assessing the cash flow cover. The more times a business CFC is, so the higher this number is in times, the better off the business will be in terms of liquidity and meeting its short-term financial obligations. The extra cash could be used to expand business operations, so you could buy some other things to make yourselves more profitable, reduce its debts, so pay off loans, or invest. So you could buy maybe some new computer equipment, some new vehicles, something to help your business grow. And that's it, guys. That's everything in chapter 7. Now please complete the rest of the questions, and if you have anything that you need help with, please email me or call me. See you later.